Good morning, students. I am Professor Bindiya Gupta from SIIT, Bhopal, from MBA department. Today, I will teach you about the financial management. Financial management is a second semester subject. In unit first, one topic is there. This is a DuPont analysis. Today, we will study about this. It's also called DuPont analysis, also called DuPont identity, DuPont equations, DuPont model, DuPont method, and it's pioneered by a DuPont company of United States. It is a system of financial analysis which received widespread recognition and acceptance. It was developed by a DuPont company for analyzing and controlling financial performance. It is expression which breaks return on equity into three parts. First one, profitability, which is measured by a profit margin, operating efficiency, which is measured by asset turnover, and third one is financial leverage, which is measured by equity multiplier. Now, first of all, we see profit margin. In profit margin, we see the formula net profit upon sales. Net profit equals to net sales minus total cost. Now, total cost is equals to cost of goods sold, operating expenses, interest and tax. When we add it, it comes total cost. Asset turnover. Asset turnover, net sales upon total assets. And total assets is equals to current assets plus fixed assets, and current assets is equals to inventory plus accounts receivables plus cash and bank balance, and it's called current assets. Equity multiplier is equals to assets upon shareholders equity, and ROE comes from by three formulas: ROE, net profit margin into assets turnover into equity multiplier, or we can say net profit upon sales into sales upon assets into assets upon shareholders equity. And last one, net profit or a profit after tax upon shareholders equity. Now, sixth point and the last point, has an understanding how the net return on investment is influenced by the net profit margin and total assets turnover ratio. ROI equals to net profit margin into asset turnover. It's a DuPont chart. It shows all the descriptions in a chart way. ROI classified into 2 points: net profit margin ratio and total assets turnover ratio. Net profit margin ratio again in 2 parts: net profit divided by sales. Net profit, net sales minus total cost, and total cost is equals to cost of goods sold plus operating expenses plus interest and taxes. And second part, total assets turnover ratio upon net sales divided by total assets equals to current assets plus fixed assets, and current assets is from a inventory plus account receivables plus cash and bank balance. So at last, thank you so much for listening me.